Okay, why don't we get started? So, good afternoon, everybody, and welcome to today's virtual seminar from the Qatar Centre. I'm delighted to welcome Margherita Giuzio from the European Central Bank, who will be presenting today's seminar. The topic is a really important one. The question is, what effect will the transition to a net zero financial system have on the stability of the financial system generally? And Margherita in particular is going to look at the impact on credit risk in the corporate sector. We're going to follow the usual kind of rules of the game for these seminars. So we'll have a time for a Q&A at the very end. But if you have questions during the talk, please post them in the Q&A box and I can relay them to Margherita. Sounds good. Over to you, Margherita. Thank you.
So thank you very much, David. Thanks also for the invitation to speak here today. I'm very happy to present you my work, although it's a virtual seminar. I hope we can have a lovely discussion on this very important topic. So I should say this work is co-authored with Sujit Kapadia, Johannes Kremer, Ken Nihol, and Peter Watson from the ECB, and Sante Carbone from the Riksbank Bank. And obviously what I'll say today represents my own views and not those of the ECB or the Eurosystem. So as David introduced already, this paper is about the relationship between firms' transition and credit risk. But let me just start by explaining why we pursue this research and what the motivation is that let us go down this line. So, as you know, the transition to a low-carbon economy requires firms to, in some cases, significantly reduce their emissions. There are different drivers of transition risk that go from government policy change, technological change, and market sentiment, which can drive the need for firms to adapt to a low-carbon economy and reduce their greenhouse gas emission. But these drivers are very diverse and increase the uncertainties surrounding the timing and speed of this transition. These drivers can affect the ability of the firm to repay the debt and therefore the firm's credit risk. And this may have an impact indirectly on financial institutions such as banks, insurers, and other investors that may not be able to fully recover the value of their investment in the event of a default. So understanding whether and how this transition risk is reflected in different measures of credit risk is very important from a policy perspective. First of all, I will show you that the results we obtain are very relevant for the climate disclosure and reporting of firms. We will show you how this disclosure actually increases or shapes the relationship between transition and credit risk. The results will have also policy impact on the credit ratings, in particular on how the credit rating agencies do integrate ESG considerations in their credit risk models. We will show you also the indirect impact on the risk weights, which are used by several financial institutions to compute capital requirements. And last, these results will be important also for the central bank operations that, as you know, have increased a lot their exposure towards non-financial corporations in recent years. So what are we going to do? We basically are going to explore the relationship between transition risk and credit risk. In particular, we're going to answer three questions. The first one is related to how the exposure of firms to transition risk is associated with different credit risk estimates. And the punchline here is that we find evidence of a positive relationship between greenhouse gas emissions and credit risk estimates, being those credit ratings or market-implied distance to default. What is very interesting also to us is that the government carbon policies play a large role in shaping this relationship. The second question is related to climate disclosure. does it affect or moderate how the exposure to transition risk is associated with the firm credit risk? And here we find a positive answer that climate disclosure is mitigating the relationship between these two risks. And I will show you how later on. The third question instead is related to the management of transition risk by the firm. Is this associated also with credit risk? And the answer is yes, again. Disclosing a commitment to reduce the emission is associated with a lower credit risk. So our study contributes to the recent literature on credit risk and climate change in three different ways. So first of all, we go beyond the usual considerations of the firm's actual emissions and emission intensities, which are, let's say, the focus of most of the literature, as you can also see in this brief overview here. And we do that by considering the disclosure of climate-related variables by the firms, and also quantitative forward-looking emission reduction targets that can influence credit risk. Usually, as you can see here, the literature has focused on environmental score and current emissions of firms. So we go one step further. The second contribution refers to the different credit risk metrics that we consider. We analyze the effect of transition risk on two metrics, the credit ratings and distance to default, by using a common framework. Instead, most papers in the literature focus on one credit risk metric, and therefore it is very difficult to compare the results among different studies. And finally, we include both US and European firms, contrary to most papers that only consider one of these jurisdictions. So I structured the presentation to present you now these three contributions and the related results. So let me start here from the novel dataset. And obviously, if you have any questions, feel free to ask them directly. So as I said, we consider firms, so non-financial corporations. We focus on listed firms on the S&P 500 and Eurostock 600. The period goes from 2010 to 2019. And as I said, the domicile of this firm is both US and Europe, including UK. So here I listed different data sources from which we take environmental and financial variables of these firms. But maybe we can go through them later in the discussion in case you have questions. So at the end, we collect data of around 860 firms. Most of them do have a rating, so they will appear in both regressions for credit ratings and distance to default. So let me go now through the empirical framework explaining how we use this data. We have our credit risk estimate, being that the credit rating or the distance to default, and we regress this estimate on variables that proxy the current exposure of the firm to transition risk, and another set of variables that proxy the management, the strategy of the firm around transition risk. So for the exposure to transition risk, we include the disclosed emission of the firm, both in terms of levels and in terms of intensity, and a dummy indicating whether these emissions are disclosed by the firm or inferred by a third-party provider. Among the variables that proxy the management of transition risk, instead, we include the change in greenhouse gas emission levels and intensities over time, and the dummy indicating whether the firm is disclosing an emission reduction target. So these are, let's say, the backward-looking and forward-looking metrics in the same setting. Then obviously we include also some financial variables of the firm and firm characteristics that we use as controls. And for the regressions on distance to default, we also include macro variables given the higher frequency of these regressions. Important to notice here that in both cases, for credit ratings and distance to default, the higher the metric, the lower is the credit risk associated with the firm. Oh, sorry. So we want to consider both environmental metrics that look at, let's say, the current exposure of the firm to transition risk and the forward-looking one. So here I list the main ones that we use in our analysis so that we can go one by one in case you have specific questions, because I understand this is probably the new part of our data set. So among the backward-looking environmental metrics that we have in our framework, we include Scope 1, 2, and 3 greenhouse gas emissions. And these are, let's say, the CO2 equivalent tons of emissions disclosed or inferred by the firm. And also the intensities, which is basically the level of emission divided by the firm's revenue. And these two metrics are widely used in the literature, and you will see that in some cases results different if we use one or the other, because in one case we only, let's say, look at transition costs that may be associated with the firm exposure to transition risk, and in the other case we look at how these costs are sustainable, if they are sustainable, by looking at a measure of profitability. Among the backward-looking metrics, then we also have a dummy equal to 1 if the firm discloses emissions, and the disclosed change in emissions level and intensities, here computed as a year-on-year change in Scope 1, 2, and 3 emissions. And then we have a second set of variables, which we call forward-looking metrics. They look at the commitments of the firms to reduce emissions. As you know, a lot of firms are now disclosing this commitment, and therefore we look at a dummy indicating whether or not the firm is doing so, and the quantitative commitments itself. So the share of emissions that the firm is committing to reduce, and the target year, expressed here as the number of years until the target is reached. And to complete this, we also include a dummy indicating whether this disclosure is audited or not, because there could be some relationship between the credibility, let's say, of this disclosure and the credit risk estimates. So,
Margherita, could I relay one question that just relates to your previous slide? So this is from Raghav Mathieu, who asks about, firstly, the frequency with which you have these data. So when are they updated? And also, how do you deal with any missing data problems related to, some firms disclosing, other firms not?
Yeah, thanks a lot for this. So the environmental variables are available at a yearly frequency. So they are normally disclosed by the firm in the non-financial statement or sustainability report. And therefore, we cannot have high frequency data on the emissions of the firm. So by using Urgentem, which is this data provided indicated here, we can have both the disclosed emissions of the firm, and for the ones that do not disclose, an inferred emission, which is estimated by using information around the sector, the size, and the profitability of the firm. So basically, for all the firms that do not disclose, we are able to attach an inferred emission. This is not the case for the forward-looking commitment. So in this case, the firms that do not disclose a commitment would not be assigned any target. So I hope this clarifies, but otherwise let me know.
No, that's really helpful. And maybe actually a question from me on the targets. So is there any way, I guess like greenwashing is, front and center in your concerns in looking at this sort of information. And is there any way of attaching a weight to how concrete the target is, verifying the target in some way. I don't know if firms are subject to any financial penalties if they don't meet the target, some way of enhancing their credibility, this type of thing.
Yeah, no, not in the baseline. So I will show you later some results on the credibility of the targets. But in our analysis, we simply use the information that market participants and rating agencies do have available. So our aim is to see whether this information is reflected in credit risk estimates. Obviously, the greenwashing risk is one of our concerns. So we also look at, for example, if firms that do disclose a target are also reducing more their emissions, or if firms with an audited target disclose more their emissions. So I will show you these results later on.
Very good. Actually, one other question while we're here. So this is from my colleague Gulcin Ozken, who asks if there are significant differences in disclosure requirements across countries in the sample.
Disclosure requirement, well, not much, in the sense that these firms are all subject to disclosure requirements because of the markets where they are listed. So the S&P 500 has some disclosure requirements, the Euro Stoxx 600 as well. As far as I know, there is no country disclosure requirement per se. There could be some different requirements per jurisdiction. Since we have US and European firms, it's true that disclosure or reporting standards in general can change. Mm-hmm. What we do is basically by using this data set, both Refinitiv and Urgentem, they do standardize the disclosure. For example, not all firms decide to disclose their emission levels. Some only do disclose emission intensities. And therefore, we need to retrieve, by knowing their revenues that year, we need to retrieve the original level of emissions. So there are these sort of measurement differences that we need to take into account. Yeah.
Well, I'll let you continue. Thanks.
Thank you. So some status facts on this disclosure, also to answer the previous question. We see that both looking at greenhouse gas emissions and emission reduction target, the disclosure of firms is increasing. Here, these charts show the share of firms that do disclose such information over time. And what is interesting to notice is that, well, first of all, there is a positive trend in disclosing environmental information. This doesn't only concern greenhouse gas emissions, so the current emission, but also the forward-looking reduction targets. Second, as you can see, we split here firms that belong to the lower tercile and higher tercile of emissions in our sample, and we see that high emitters are consistently the ones disclosing the most, as probably they are the ones more exposed to public scrutiny from investors and from the markets in general. And third, a lot of this disclosure, actually most of this disclosure, is verified by a third party. So it's somehow audited, which is reassuring in some sense. So let me go now through our empirical analysis. We said our second contribution to the literature is that we use two different credit risk metrics, the ratings and the distance to default. So both of them are market-based expectations of what is the creditworthiness of a firm. We are all, I think, quite familiar with the credit rating. We use, in our case, the credit ratings from Standard & Poor's, but we also have some robustness analysis with ratings provided by Moody's. And for the baseline specification, we use the long-term issuer credit rating. What I wanted instead to explain a bit better is how we compute the distance to default, because market prices do also contain information about the credit risk and therefore the probability of default of firms. And you can use different models to estimate that, to retrieve this information. In our case, we use the Merton model, which relies on balance sheet information, so the fundamentals, and the equity prices of the firm. So it's very simple because it requires few data points. And the intuition of this approach is that the default of the firm occurs when the value of its asset falls below the value of its liabilities. So we reach a negative equity, and therefore the firm is in a state of default. To implement this idea, Merton applies the contingent claim analysis on the balance sheet of a firm. And this way, we can treat the equity of a firm as a call option on its asset, with the exercise value equal to the present value of the firm's debt. So using the simple option pricing of an American call option, we can then extract what is the market-implied estimate of firm's credit risk by using only the information that we have available in capital markets, so equity prices and firm's balance sheet. So let me show you the first set of results on the basic relationship between rating, in this case, and current emissions of the firm. So we regress, as I showed earlier, the rating of the firm lead by 3 months on the scope 1, 2, and 3 emissions, some financial controls, as well as sector, time, and country fixed effects of the firm. For the credit rating, we use both the OLS estimation and logit regressions, but here, for the sake of time, I will show you only the logit results as they are basically our baseline. So all tables will show you the results for both emission intensities and emission levels, because they are the standards, let's say, in the literature, and because we think it's also important to compare the results because they provide somehow slightly different information about the transition risk of the firm. So what is interesting to notice is that by focusing only here on the relationship between rating and transition risk variables, we see that higher scope 1 and scope 3 intensities are associated with lower ratings, which means higher credit risk. So the higher is the exposure of the firm to transition risk, the higher is its credit risk estimates based on rating agencies. Interestingly, we also find similar results for scope 1 levels, this time not for scope 3. So the scope 1 levels are the very direct emissions of the firm. So the same, let's say, questions is posed now on the distance to default. Here we use a simple OLS estimation. Again, we regress our credit risk metric on the environmental metrics that proxy the current transition risk of the firm. And here, consistent with the previous results, we find for the emission intensities that scope 1 and 3 are associated with lower distance to default, so with higher credit risk. Again, therefore, the larger is the transition risk of the firm, the larger is its credit risk estimate. In this case, we do not find the levels of emissions to be significant. So this is basically our, let's say, the answer to our first question on the relationship between transition and credit risk. It looks like both credit rating agencies and financial market participants are pricing this risk in their credit risk estimates. Now we go to our second question, which is related to the role of climate disclosure. So by using the same empirical framework as before, we now add the dummy variable on the disclosure of current emissions, a dummy variable on the disclosure of commitments, and also here a variable indicating how scope 1 and 2 emissions of the firm has changed over the last year. So why do we care about disclosure? Because we think that disclosing any environmental information can send a positive signal to the market that the firm is at least aware of the transition risk. So as we know, we cannot really, it's difficult, let's say, to change something that you cannot measure. So this is seen as a positive signal both for credit rating agencies and for financial market participants of the awareness of the risk. The second, instead, the second disclosure dummy indicates whether the firm has a plan to reduce this transition risk in the future. So this should also provide a positive signal to financial markets and rating agencies. And indeed, what we find for both emission intensities and emission levels is that the act of disclosing emissions is associated with better ratings. You see it here for emission intensities, emission levels. And also committing to lower emissions is associated with better ratings. Again, a very strong signal to credit rating agencies and financial markets. What is also interesting is that a reduction in disclosed emission intensities is associated with better ratings. So it looks like credit rating agencies are monitoring the evolution of emissions over time. Now, in this table, I show you the results obtained by using the dummy of emission reduction commitments. But in the paper, you can also find some results by using the quantitative measure of these commitments, basically the effect of the reduction target and the target here. And in particular, we find that the more ambitious the target, the larger its positive impact on the ratings. Now here, with the logit regression, we basically focus on the significance of the different coefficients. But obviously, what we want to do eventually is to study the economic significance. So are these variables really driving changes in credit ratings? And the answer seems to be positive. So here we plot the estimated impact of a one standard deviation change of different variables on credit ratings. So here we focus first on these two blue bars, which are basically the variables indicating the current emissions of the firm. And we can see that higher scope 1 and 2 intensities do have a negative impact on credit ratings by half, basically, of a rating notch. And also an actual increase in greenhouse gas emissions tend to lead to worse ratings. Of course, here the magnitude is much lower, but the standard deviation of this variable is also a bit higher. Going now to these yellow bars, we see the impact on the ratings of the two disclosure dummy, the dummy of emission disclosure and the dummy of target disclosure. And here we see instead the positive impact that they have on ratings. So when firms disclose this information, the ratings looks better. What is interesting to notice is that the magnitude of the effect of this greenhouse gas intensity is very much comparable to the magnitude of the effect of leverage, which is one of the main drivers of credit rating change. What is interesting to notice here is that obviously this graph holds true for, let's say, the average firm in our sample, but a high emitter would have the negative effect on ratings coming from high emissions, probably outweighing the positive effect on disclosure. So it's still true that two firms that have the same emissions, among these two, if one discloses information, this has better ratings. But I mean, we need to notice the differences also across the distributions of emitters.
Margherita, could I step in and convey a couple of questions to you?
Yeah.
So I had one question to start with, and my colleague Reese has a question as well. I might ask him to put it directly to you, and it may be a similar one actually, which is, I guess, kind of one concern might be, particularly with the targets that you're looking at. You know, this is kind of a proxy for good governance in the firm generally, right? So, kind of well-run firms are probably ahead of the game in this area. just like they are in many other areas. So, you know, rather than picking up the effect of disclosing a target, you're picking up just kind of good management, good strategic awareness on the part of the firm anyway. You have a bunch of controls in this regression, but do you want to say something about like how you think the controls are kind of dealing with that issue? And well, why don't you take that one first? And
yeah, I'm very happy. So this is something, actually, one of the first feedback that we got when presenting these preliminary results a year ago or something. Because indeed, there could be some endogeneity concern if we do not take into account firms that normally have better governance. And for this reason, we have as control a governance score, which is provided regularly, like for all the firms in our sample by ICON. And basically, it's similar to environmental scores that you may be sort of familiar with. And it ranks firms belonging to the same index or to the same sector according to their governance. So there are different, let's say, parameters that are assessed by commercial data providers, and therefore we obtain a score for each company, and we include that as control so that we are somehow sure that we are not assessing the effect or including the effect of these differences in governance when looking at targets. And also one thing that we do, if that is not enough, let's say, to moderate the concern related to this, is the analysis we do on the magnitude of the target, so the quantitative information that companies disclose. And indeed, when we look at the impact of quantitative targets, so the share of emissions that the company is committing to reduce, we find that this has a positive impact on credit rating. So it's not just the act of disclosing, but also how much you disclose to reduce or you commit to reduce. But definitely this was one of our endogeneity, let's say, related concern.
Thanks. Reece, do you want to ask your question as well?
Yeah, I mean, I think it was very close, and I think partly some of it has been answered. Yeah, I mean, I guess I'm just asking about you know, a firm fixed effect, essentially, as you're well aware, and I guess when I thought you were just using dummies, that was going to come down to, you know, before or after they start reporting. Now, you just mentioned you use quantitative. I wondered if that might give you some sufficient variation even with a firm level dummy in there, but maybe you could speak to limitations of the data perhaps on this. I clearly, you have other fixed effects. It's not like you are aware of this, but maybe you could speak to that a little bit.
Yeah,
I mean, what you need is what you need is some sort of quasi random variation in when they get reported. So maybe, I don't know, if some hedge fund comes in and activist investors, maybe might be some sort of experiment you could. Anyway, I'll let you speak to it.
Yeah, definitely. So let me maybe show one of the slides I have in the appendix, looking at potential endogeneity drivers. So let's say that those variables that can also have an impact on the adoption of climate disclosure by firms. So we mentioned already governance. And we indeed add this score as a control. But obviously, there are country-related policies around the transition or energy mix of the country that may affect the activities of specific firms. And for this reason, we have country fixed effects. For very similar reason, we have sector fixed effect. And I will show you a more specific analysis on the pre and post Paris Agreement. But in these, let's say in the OLS and panel regressions, in the baselines, we also include year fixed effect, because indeed there is also a time variable to take into account. There are also other firm-specific, let's say, characteristics that may influence the disclosure of environmental variables. As I showed you before, high emitters tend to consistently report more because probably they are subject to higher scrutiny. And therefore, on the same line, there could be some firms that, let's say, market themselves or are more active in greener activities, and therefore these may, let's say, increase their ability and convenience also to disclose a certain emission reduction target. So we take this into account by including in most baseline regressions the firm fixed effects. Where we do not include it is because indeed there is no much variation. And in some cases, it's more effective to take only country and sector and time fixed effects. But definitely this is one of the caveats, mainly driven also by the fact that we do have this information at the yearly level. So it's very hard to, to measure any more frequent change in the data.
I guess I was thinking about whether like an activist investor is sort of close to having controlling amount of stock or something like this, and you can look around there. Like anyway, but it's very hard.
Proxy voting.
Yeah, just whether or not you could say, well, suddenly this, for some other reason, this, I don't know, BlackRock or somebody who got ESG props somehow got involved, then you've got like something orthogonal to the companies why they're now reporting, and then you can look around there. But you probably don't even have enough variation in that case anyway. Anyway, very interesting.
No, that would be very interesting for sure to have. I'm not aware of data that go, let's say, before 2021, maybe when you have this very large commitment also from institutional investors and asset management companies with the G funds, for example. But I'm not aware of any data that capture this, let's say, at least since 2010 or 2015 after the Paris Agreement. But that is obviously one of the caveats to keep in mind. That's for sure.
Thanks. Go ahead.
Thanks. So basically, we ask the same question around disclosure also for, let's say, the analysis on the distance to default. Here again, to the framework that I presented before, we added this disclosure dummy, both on the level of emissions and the commitments, and this year-on-year change in scope 1 and 2. And similarly, as observed for the credit ratings, we find that the act of disclosing the current emissions increases the distance to default of the firm, so it leads to lower credit risk. And committing to lower emission increases as well this metric. Again, I will not show the results here, but the analysis on the quantitative targets show that the more ambitious the target, the larger is this effect. Now, in the paper, you will also find a bunch of alternative specifications, including with or without a firm fixed effect, sector fixed effect, etc. But the results are, at least for this baseline, results are very robust, with the caveat that somehow we mentioned. Now, let me come back to your question, David, on the credibility of targets, because a natural question is indeed how realistic are these plans of firms? Is there any greenwashing risk going on? And on this, we find some evidence that firms that do disclose a target tend to also reduce emissions more in the following years, which is sort of reassuring on this front. So you see this on the left chart, which shows these box plots for the year-on-year change in emissions of firms that do disclose a target versus firms that do not disclose a target. Now, here I show you only the 1 year change, and therefore 1 year reduction in emissions. But in the paper, you will also see that this is true for the longer, let's say, time period of 3 years. So it looks like firms that do disclose a target tend to reduce emissions more, slightly more. Now, the second question that is also interesting is related to one of the references in the literature, the Giudice and Rigamonti, which showed that audit improves the quality of ESG scores. So here, in general, we know that audit of non-financial statements can be a proxy for the rigorousness of the emission reduction target. But we do not find this relationship to be, let's say, this variable to be significant in our analysis, because there is no significant difference between the companies that have their targets audited and the companies that do not. It's true that the two samples vary a lot, in the sense that in the first block, in the first group, we have over 366 observations. In the other one, we have 45 only. But let's say we do not find any significant difference. So being audited here seems not to be that that relevant to or a driver of emission reduction, let's say. So it looks like the monitoring of the market in terms of targets may be already a good driver for firms to reduce their emission, since they know they are subject to this market scrutiny. So we're leading towards the third contribution. I'm not sure if there are any other questions related to this analysis. Maybe I'll take this at this point.
I think you're good to continue. I mean, there's one question that came in the Q&A that I was saving for the right moment, but as you paused, I'll ask you now. So this is again from Raghav Mathieu, who's asking about whether there's information in green bond data that could capture some of these effects, in addition to looking at distance to default, which I think is an interesting idea. So,
yeah, so there is some recent literature, both on other metrics, let's say, of credit risk. So you can look at the spread of bonds of different type of emitters, spreads between green and non-green bonds issued by the same non-financial corporation. You can look at CDS spread. So there are other market-implied, let's say, credit risk metric that you can use. For green bonds, actually, there is the work of some colleagues at the ECB, which show that while in the they show basically in the secondary market the existence of the so-called greenium, which is a premium basically to invest in green bonds. At the same time, it's not clear if part of this premium can be driven by credit risk differentials, especially if you compare bonds that are issued by the same firm. Obviously, the credit risk doesn't change because the firm is the same. But in general, there is a difference between green and non-green bonds. Now, it's an empirical question to assess how much is related to liquidity, because obviously the supply of green bonds is much lower, to credit or other characteristics of the bond.
Yeah, that's a good answer. And so another question that's just popped in by Gulchin Ozkan, who's asking, I guess this is in relation to the chart on the left, whether is it kind of the case that for firms that are disclosing targets, is it not just that their emissions are falling, but whether they're meeting their targets or surpassing their targets? Have you looked at kind of this as an additional? Sorry, you go.
So yeah, I think in the short, medium term, we will be able to compare this. But at the moment, there is no target, no commitment that have reached already the target here. So we cannot say if the firm has failed to reach the target or not. We could look at, let's say, how close they are to the target. So basically look at, let's assess whether they are more or less in line with the target that they have committed to. At the same time, it could be unfair to do that in the short term when they've just committed to this target, because it could be that the largest emission reduction is occurring towards the end, where there is, for example, potentially a technological change or some new investments that would be in place. So we do not do that for this reason. But in theory, it could be possible to sort of assess this.
Brilliant. I'll let you continue.
Okay. So in the last analysis, as you remember, the third contribution to the literature is to assess whether there are differences between European and US firms. What is the motivation to do so? We know that the exposure of the firm to transition risk is closely related to the government policy, and particular to the country in which the firms operate. So we investigate whether the credit rating agencies assess European firms differently from US firms, given the different environmental policies in the two jurisdictions. We know that in European countries, we have low carbon transition policies, including the emission trading scheme or the emission trading system, which is effectively a carbon market, and we have that since 2005. By contrast, in the US, we do have a carbon price. We don't have a proper low carbon transition policy, and also the US has withdrawn from the Paris Agreement in 2019. So we want to exploit the Paris Agreement as as an exogenous shock that on the one hand increases the climate-related regulatory risk that firms face, but on the other hand, it doesn't change the environmental profile of the firm, so its emission. So to do so, we split firms into a treatment and a control group. So the treatment firms are defined according to 3 criteria, which are consistent with the literature, and for which we run 3 different specifications. So in the first case, the firm belongs to the top polluting industries based on Eurostat data. In the second one, the firm is in the treatment group if it's among the most polluting firms according to Scope 1 intensities. And in the third one, if it's among the most polluting firms according to Scope 1 level. We include the same set of control that I described in the previous analysis, but for European firms here, we also include the EU ETS carbon price to account for the carbon market. And basically what we do here is to include another dummy indicating the years after the Paris Agreement. So this dummy is equal to 1 for years that go from 2015 to 2019. To check whether, let's say, this event has changed how credit rating agencies perceive transition risk-related credit risk. So what we find if we focus only on European firms is reported in this table. Here you have 3 columns, one for the different treatment groups. So on the first one, you have firms in the top polluting industries, indicated here as the NACE sector. In the second one, you have treated firms, which are among the ones with the highest Scope 1 intensity, and the third one with the highest Scope 1 level. And what we find is that polluting firms do have statistically significant lower ratings in the post-Paris world. So firms active in the most polluting economic activities, for example, see their ratings fall by an additional half a notch relative to the control group. And similarly, most polluting firms see their ratings fall by an additional 0.38 notch relative to the control group following the Paris Agreement. And this means that in Europe, there is strong evidence of a post-Paris effect on credit ratings. So the commitments of governments played a large role to shape this relationship between transition and credit risk, at least the ones that goes through credit rating agencies. And interestingly, these results do not hold on the sample that includes both European and US firms, because it seems that US moves in a different directions in terms of ratings for top polluters. And indeed, in the next and final analysis, we look at the differential impact of transition on US versus European firms. And we do so by employing a triple definitive approach. So we add here another dummy equal to 1 if firms are domiciled in European countries. Again, here, the rationale is that although the US signed the Paris Agreement, the credibility of its commitment to reduce emission was somehow limited by the presidential election in 2016, the announcement in 2017 of the withdrawal from the Paris Agreement, which eventually happened in 2019. So also here, the columns refer to the different treatment group definitions. And from the first, comparing the first 3 rows to the second 3 rows, we can see that after the Paris Agreement, the ratings of the most polluting firms in Europe worsened relative to the US peers. And the magnitude of the worsening is of the order of 0.9 notch when considering firms in the top polluting sectors, and about half of a notch when considering firms in the top quartile of emission intensities and levels. And by contrast, the positive signs of the estimate for US firms post-Paris, you see that they are all positive, they suggest that credit ratings actually improved for the most polluting firms following the Paris Agreement. So overall, these results indicate that the causal relationship between transition and credit risk depends on the extent of national climate change and carbon reduction commitments in the country where these firms operate. So are there any questions on this? Otherwise, I'll jump to the conclusions.
Why don't you do the conclusions and then we'll take some questions.
Good. So basically, to summarize, what we have done here is to show this positive relationship between transition and credit risk. And what was very interesting, striking to us, is also that governments' transition policies seem to affect and shape this relationship, at least for credit ratings. Now, we clearly have to do a lot of work on the data availability, reliability, and especially comparability of transition risk metrics, but our results point to a certain direction, especially regarding disclosure, because both disclosing emissions and disclosing targets is associated with better credit ratings and distance to default. So it looks at disclosure moderates the relationship between transition and credit risk, is seen as a positive signal. And why the results are important also for policy. First, because they show the need to enhance corporate disclosure, not just of current emission variables, but also of credible forward-looking plans of firms. We know that there are a lot of international initiatives. The IFRS is working on this, CSRD, etc. But we still want to highlight the importance of these forward-looking emission reduction targets, especially to assess the credit risk of the firm, which is a metric that looks at the future. The second policy implications are related to how credit rating agencies are incorporating ESG factors in their credit risk models. And in Europe, in the EU, there is ESMA working on some requirements regarding the transparency of credit rating agencies' models. And third, there are important implications for the prudential framework for financial institutions, especially the differences that seem to be currently in place between financial institutions that use the standardized approach and the internal rating-based approach to compute capital requirements. Because the ones that use the standardized approach, therefore they use credit rating for their assessment, they seem to already take into account, to some extent, transition risk-related credit risk. Instead, the ones that are currently using internal rating-based approach do not necessarily do so. There is currently, obviously, regulators are working on supervisory practicing and reporting for banks and insurers, but there is potentially a mismatch going on currently. And last, the transition risk can also affect the value and the risk profile of the assets held by central banks. And for this reason, for example, the ECB has decided to introduce disclosure requirements for assets from the private sector as a new criterion for eligibility, both for the collateral and for asset purchases. And the allocation of bond purchases will also start to reflect some climate considerations. But going forward, our results also point to the need to consider firms' forward-looking targets and strategies when assessing risks in the monetary and non-monetary policy portfolios. But I guess we will hear more about these commitments for central banks as well in the course of 2022. So let me conclude here my presentation. Thank you all for your questions already and for your attention. And I really look forward to the discussion.
Thank you very much, Margherita. So let's have a Q&A. So if you've got a question, please stick it in the Q&A box you can see at the bottom of your screens. There are a couple of questions in there already. I'm going to be cheeky and ask you a couple that I also wanted to ask as you were going through the presentation, and then I will relay the one that's in the Q&A box. So one thing that was in my mind was about whether there's pricing power that varies across sectors that should kind of be reflected in these credit risk assessments in some way. So I assume the transmission mechanism you have in mind is, there's a carbon price that's increasing, that's hitting a sector, that's going to reduce its profitability, and you could end up having some credit risk event as a result. I guess for firms in some industries, they're going to be able to pass on those higher costs to consumers, so they're kind of more insulated than others. So I was wondering if that might show up across industries as like as an interesting check on your findings. So that was one thought. Another one was around, I guess, the the maturity of the bonds that are being rated here. And if they're kind of like 3 or 4 years, that would seem kind of quite short term in terms of actually reflecting transition risk, which I guess in the most cases we're talking about 2030 onwards. So I was wondering what your thoughts were on that. And then I'll convey the third question just so you can answer all three. So this is from Fabrizio Ferriani, who's asking about, I guess, noting that you find different results across scope 1, scope 2, and scope 3. And kind of what your interpretation is of how, why these are showing up differently in terms of your empirical findings.
Okay. So thanks a lot for these questions. So on the first one, on the possibility to basically transfer this price to consumers, this is something that we currently do not include. Let's say if this is a characteristic that is common to all firms belonging to a sector, we could think this is somehow captured by the sector fixed effects. If we think instead that within the same sector there are firms that are able to do it more than others, then we, at the moment, do not capture this effect. But I will think better about this and see also how we could proxy this going forward, if there are substantial differences within the same sector. So thanks a lot for this comment. On the maturity of the bond rated, so we use the issuer rating. So they are normally not, so this type of ratings are at the issuer level, not at the instrument level. So the maturity should not have, let's say, a decisive impact on the credit rating. But there is a mismatch, for example, between the two credit risk estimates in terms of maturity. There may be a mismatch because while credit rating agencies normally attach this issuer rating, let's say, and assess the credit risk of the firm in the next 3 to 5 years or even longer, a bit longer, the investors in the equity markets may have longer term, let's say, estimates. So in comparing the two sets of results on ratings and distance to default, there may be a difference also in let's say, the duration or expectations and investment horizon. And on the difference in results between scopes, so this is also an interesting question. We interpret the results by basically grouping the scopes in two groups, so the scope 1 and 2, which are the so-called direct emissions of the firm, and the scope 3, which instead proxy the indirect emissions of the firm, so the ones that are related to providers or clients. And this may have a different impact on the credit risk of the firm, simply because a policy on a carbon price, for example, or any government policy related to carbon price may be set at the level of scope 1 and 2, but not at scope 3. Scope 3 cost may concern the direct emitters. So there is a difference in interpretation. And indeed, we are very much careful in interpreting the results, especially for scope 1. Less so for scope 2, because these tend to be very small relative to the other type of emissions. And we are less interested in the results for scope 3, just because the costs are not necessarily sustained by the firm. So I hope this clarifies a bit.
Perfect. And you're bang on time. So we've reached the hour. So Margherita, thanks for a really fascinating talk. Lots of rich material. Yeah, that's a big round of applause and thank you.
Thank you very much. Thank you.
Okay, thanks everyone, and we'll see you all in 2 weeks.